forget all the noble words you said when you get down to the bottom line. Get down to the bottom line. Get down to the bottom.
Yes, sir. We are back. It's been a minute since we hit one of these recaps. Specifically today, we're actually going to talk about one of the, in my opinion, one of the biggest economic indicators and really conversations that's going on right now, which is the K-shaped economy. So we're going to jump on in. I'm going to share screen, but I'm going to make sure y'all see the whole thing because we got a few slides that I'm going to walk through to give a better explanation on how this works, what it means, but also what steps you can take to ensure that you are on the right side of it. So in my personal and professional opinion, I definitely think these are the type of the conversations we need to be having. If you're trying to build wealth, if you're trying to protect your family, or even just trying to figure out like, what are these rules to the game, right? And what I feel like is changing for me. So K-shaped economy, as I just mentioned. So it may sound like something like, yo, is this something that we learned in finances, or is it probably I'm having a tough time with my terms today. But I promise you, but by the time we finish up this episode, you're probably going to see it everywhere because this is going to give you some insight and an understanding of just how these things work. So either in your neighborhood or if it's in the news or even in your own bank account, you're going to know, and we want you to know exactly what to do about it. So what this K-shaped economy is and why it keeps happening, because it's not new. What it looks like exactly is what you see. It's the K. And so even within this presentation, you see this dotted line going down the middle, you see this green line going up, and you see this red line going down. And so even with the current economic environment, we're going to make sure that you have some tangible steps that you can take to make sure that you are climbing that upper arm of the K. And so what this represents, right, is the basics. So the letter K is exactly what we're talking about. So when an economy experiences a shock, and we're going to go through some of the historical moments when that has happened, if it's either through a recession, if it's either through the pandemic, if it's either through a financial crisis, we would typically think that this graph here would be turned on its side, like more like a letter V, but that's not actually the case. Everything goes down, everything goes back up together, like the letter V. But unfortunately, it's not a situation where everybody suffers and then everybody recovers. It doesn't work like that. Instead, what we're seeing is this split. And that's why this K-shaped economy is very, very important. And it hits a shock. So let's say 2020, it separates. So there's a group of people that are invested in the stock market, that have real estate. They may be landlords or developers. They're business owners, executives, entrepreneurs, high-income professionals, those with some type of diversified savings, right? Like it separates those that own assets. They end up shooting upward. That's that green line that we see here. Unfortunately, their wealth, well, I'll just say fortunately for them, their wealth not only recovers in shocks like this, it actually accelerates. So now, and this is the unfortunate part. So there's this other group, right? This red part where the lower arm, the wage earners, right? So these are the folks that you would consider as working class Americans. So you got your hourly workers and people who don't own significant assets, as we talked about, either through the stock market or through real estate or, some of the other examples. Not only during this shock, they struggle, but they continue to struggle because their wages may go up a little bit, but that cost of living is outrunning them. So the cost of buying food, the cost of being able to take care of your family, that is increasing, but the money that you're making on a month-to-month basis, on a year-to-year basis, unfortunately, that is not increasing at that same rate. And so what does that create? That creates the letter K, right? And so as you can see, green, red, and you're using that yellow line, as that background there, and you can see that K really start to form out. So here's what I want you to understand. This economy, and typically when folks think about the economy, is only through the form of income, right? Oh, K-shaped economy, income. No, not necessarily. It's really about asset ownership. So the people going up aren't necessarily the ones making the most money from their jobs. They're making more money because the things they own appreciate: stocks, real estate, businesses. So when a Federal Reserve lowers interest rates or pumps money into the economy, those assets go up in value. And guess who benefits? The people who already own them. Now this lower arm, they largely depend on wages. Like, hey, yo, I need my money coming in, and I need it coming in on time. And wages, when you account for inflation, have barely moved for the average Americans, especially over the last 20 years. So putting this into context. So before you think about this is some brand new phenomenon, I want to be very clear. The K-shaped economy has happened before multiple times, and understanding history is going to be very important. So just as a recap, upper arm, those that have assets, those that have real estate, they're invested in the stock market, they have investment portfolios, business owners. And again, typically those are in high income, right? And so that asset ownership is very, very important. This lower arm, right? These are typically hourly workers or wage dependent households. If you're living paycheck to paycheck, renters with no property equity, workers in automatable routine occupations. So something that could typically be replaced by AI in some form or fashion. Those carrying high interest consumer debt, and then households without investment accounts. These are the folks that are on that bottom arm of that K. So now we're going to look at this chart. So this is a historical representation of what has happened going all the way back to 1913, right? And so this reflects the national wealth held by the top 1% of Americans going back into the 1900s. So just a few things that I want to point out. So they call this the Gilded Age, right? And so late 1800s, early 1900s, as you can see here. So we got the early 1900s starting around here, the Gilded Age. This reflects when the Industrial Revolution was created. And so there was a ton of wealth created out of that. And it was extremely concentrated at the top. So of course you got names like the Rockefellers, the Carnegies, the Vanderbilts, right? Like these are all names that we are familiar with when you think about folks with money. Meanwhile, the factory workers were earning poverty wages with zero labor protections. Classic K shape. So you got the Gilded Age that occurred here. And again, like I said, this is not a new situation. It has happened over a period. So that Gilded Age ultimately goes from the 1880s to 1929. Top 1% holds roughly about 40%, 45% of the wealth, as we can see here. Alongside that, those that were typically doing the work, these were the factory workers. These folks were, unfortunately operating in poverty. All right, then what happened? Two things. We had the Great Depression hit. Ouch. And then, rather than recovering in a K, the government made a fundamental decision. This is why when I hear all this, closing the wealth gap, I'm like, well, policy got to play a major role in that. One, we had FDR's New Deal, which was very important in supporting that. You had the GI Bill, which ultimately created the middle class. And then you had progressive taxation and then the union expansion. So from the 1940s through the 1970s, we actually had a compressed wealth gap, right? The middle class expanded dramatically. And that's that flat part of the chart that you see here. This is where you see it kind of flatten out, right? And so, and it wasn't by accident. It was policy. So not only the assets and the decisions that the people made, there was policy that was put in place that helped accelerate households and individuals' ability to be able to participate in this wealth creation that was established. Then, as we can see what happens in the 1980s, this is when the Reagan era begins. And so there's significant tax cuts for the upper income earners. Similar conversation you hear now in regards to deregulation. The unfortunate decline of unions. Got to shout out my guy, DeMar Smith, the former executive director of the NFLPA, talks heavily on how they were able to really operate in the best interest of NFL players during his time of leadership. And, you know, when you think about how that wealth gap starts to widen a good bit, these are part of the triggers that occurred. And so, as you can see, that top 1% climbs from 22% back towards about 35%. So during the 1930s and the 70s, we can see that top 1% falls to 22%, and they were previously at 45% due to some of these policy that was established, the GI Bill, progressive tax, union expansion, and that compressed that wealth gap. But during the Reagan era, due to the tax cuts, due to the deregulation and the union decline, that wealth gap widens again, and that top 1% goes from 22% to then 35%. Very, very, very important. So the wealth gap widened again steadily. And then this is probably a crisis that we're all aware of. Then 2008 hits, the financial crisis. And this is where that K-shape really becomes clear. You can see due to some of the quantitative easing, which inflates assets, the market is able to recover. You got faster wages, recovered fast. You got wages being stagnant. That top 1% exceeds the 38%. And then food stamps hit a record of 47 million users in 2013. Here's some of the data right here. And so this gives really a reflection of, again, those that have assets. When events happen like this, what occurs to those that do not have assets, and how are they able to essentially recover? So after that 2008 crash, the stock market recovered to pre-crisis levels by about 2012. Home prices in major markets recovered by 2013. So 4 years from the 2008 crash, it got back to where it was. And then 5 years after the crash, home prices were able to recover by 2013. And corporate profits, guess what? Guess what they did? They hit record highs. But unemployment for working class Americans, it took until 2016, 8 years to recover to the job loss in 2008. And then real wages for the bottom 50% barely moved during that entire decade. So food stamp enrollments hitting a record of 47 million in 2013. You got the Fed's quantitative easing, essentially buying assets to inject money into the economy. So it inflated the stock market and real estate. So if you own those things, you got rich. If you didn't, you got nothing. Then, of course, through 2020, in 2020, here comes COVID. And we see it again, but faster and more extreme. The stock market crashed in March of 2020, and then it recovered to all-time highs by August. Just that quick, 8 months. That is one of the fastest recoveries in history. Meanwhile, by December of 2020, 20 million Americans were still claiming some form of unemployment assistance. So the K-shaped was not only sharper, it was faster, more visible than ever before. And that pattern is not over. So where are we now? And again, I'm going to highlight a few of these things that we talked about. 2008, 4 years to recover. COVID took 5 months to recover in regards to the market. The amount of billionaire wealth during the COVID era increased by $1.3 trillion. $1.3 trillion. And so it took 8 years for jobs to recover, but it barely took a year for the market to recover. And so it's one of those things where once you see how the economy works and the role that you can play alongside of it, it's going to be in your best interest to own assets. So in both crises, Wall Street recovered in months and Main Street took years. And Main Streets are ultimately the folks that are the working class. So who owns what in America? And I think this is very important to get an understanding of, like, all right, where am I and how can I get on that other side of it? Because the K-shaped economy is very much alive in this current environment. Now, there's some dynamics that's making it particularly sharp, but let's look at just a quick breakdown of asset ownership by income tier. So as we look at this chart, you can see that the top 10%, so these are the folks that are in the green here, the top 10% of American households own approximately 67% of all stock market wealth. The bottom 50%, collectively own less than 1% of stocks. Again, I'm going to say that one more time. The top 10%, these are the folks that make $150,000 or more in income, own 67% of the stocks, 45% of the real estate. They have 78% of the business equity, and then 50% of the retirement assets. The top 10%. The upper mid, so that's 60,000 to 150,000, they own 30% of the stocks. That's a shocker, right? That's a shocker. Because when the stock market goes up 25% in a year, which it did in 2023, guess who benefits? Not the people who don't own any of it. The real estate, it tells a similar story. Home ownership rates among households earning under $50,000 per year have actually declined over the past decade, even as home values have more than doubled in many markets. Renters are paying more, landlords and homeowners are building more equity, and the gap widens. So we layer in what's happening in the economy right now. We have elevated interest rates, and our current president is not happy about that. The Federal Reserve, of course, it actually aggressively raised rates from 2022 to 2024 to help try to fight inflation. But what does that do? It makes mortgages more expensive. It makes car loans more expensive. It makes carrying a credit card debt more expensive. So these are burdens that are disproportionately hitting the bottom half of the income distribution. At the same time, those high interest rates are generating income for those who have savings, who have accounts in which they're making money, money market funds, treasuries, and bonds. So if you have a $500,000 investment portfolio, you are earning 5% on safe cash equivalents. That's $25,000 a year in interest without taking any risk. That's $25,000 a year that you are able to utilize in areas that could better off your life or even furthermore investments. And so if you have no savings, those rates mean nothing to you except higher bills. And then there's this tariff environment where we've seen significant tariff increase on imported goods. The evidence is pretty clear. Consumer prices go up and lower income households spend a higher percentage of their income on these types of goods. So if it's electronics, if it's what you got in the house on those household items, clothing, those are the most affected. The upper bracket, they feel it, but it's a rounding error on their balance sheet. And then you add artificial intelligence and automation into the mix. Come on now. That's more long-term structural that is going to really a force that's going to displace a significant number of middle skill jobs that's going to feel like doing middle school over the next decade. So the people whose jobs who are more at risk in the middle of this income distribution are those that are in the middle class and the lower class. Meanwhile, those who own technology companies and AI infrastructure are poised to see their wealth expand dramatically. So again, unfortunately, those that are making under $30,000, you represent that, less than 1% you own in stocks. 37% are in a position of home ownership. And then when you think about business equity and retirement assets, it's fractional. You get into that 30,000 to 60,000, and this represents 2.5% of stocks, about 54% of home ownership, a little bit more business equity, 4% of retirement assets. But the more income, the higher class that you see, or the higher tier that you see better participation. And so I think the biggest shock more than anything is that almost 70% of the stock market, so ultimately 67% of the stock market wealth is owned by the top 10%, by the top 10% of those that are in that income tier. Let's keep rolling, y'all. All right, so this is what you can do. So let's get on the right side of the K. So the good thing is, if you are watching or listening to this, you may say, all right, well, what do I need to do? All right. So here's a few things you can do, because this really ain't about politics. I ain't getting none of that. I'm all about the people. And I'm not trying to get into politics, because that does sound like a slogan. All right. So I ain't here to tell you what party is right or wrong. I'm really just here to tell you what the data shows and what you can do to help position yourself on the upper arm of that K, regardless of where you're starting from. So you can become an asset owner and not just an income earner. So the single most important shift you can make is transitioning from being primarily an income earner to becoming an asset owner. And this is really the fundamental, we'll just say, divide in the K-shaped economy, because income gets taxed, right? Income can disappear, assets appreciates, and then assets compound. So if you have a 401k, shout out to you, have being, employed that way. Starts with your 401k or your IRA. If you're not maxing out or your tax advantage retirement accounts, you're leaving money on the table. And staying on the wrong side of the K, you don't want to be there. So in 2025, you could have contributed up to 23,500. In 2026, that is now 24,500 to a 401k. And of course, there are those catch-up contributions if you're over the age of 50. Roth IRA, that is at 7,500 for 2026, because these really aren't just retirement accounts. It's the entry point into the stock market as an asset owner. So let's make sure that you are funding these vehicles if you have them. If you are not currently working and you don't have access to a 401k or something of that nature, let's make sure that we check out either a Roth IRA, and then do your research educate before you allocate. This is not investment advice. This is not investment advice. This is not investment advice. Educate before you allocate. Speak with a professional that can help you with these steps. And again, if your employer offers a match, that is an immediate 50 to 100% return on your money, because there's no investment on earth that can compete with that, right? So make sure you capture every dollar. Step 2. Now, I do understand that in this environment, especially when it pertains to interest rate, buying a home could feel like it's impossible, especially for a lot of people. Prices are high, rates are high, everything high. So, but I do want you to think about real estate a little bit differently. Every mortgage payment you make is building equity in some form or fashion. There are ways in which, you may not want to wait or take 30 years to be able to pay for the home. I don't recommend that, because there's a thing called interest, and there are tax advantages to it, but let's make sure that we're maximizing our strategies very effective and efficiently. But it's really a forced savings that in an asset that historically appreciates. Because when you think about it, every rent check feels like you're building someone else's equity. Now, I know that there's a lot of stuff out here when it pertains to, hey, rent is better than owning, whatever. Location is very important, even if you're not able to benefit of the true one's ability to be able to leverage that asset to create more assets. Worst case scenario, the next generation will. So if home ownership isn't readily available, there is ways in which you can get into it, which is called a REIT for short, real estate investment trust. You can invest into the real estate through the stock market just with a few $100s. You could get some dividends and some price appreciation without needing a down payment. It gets you into the asset class, right? And so again, we want to get you into assets. Now, the one thing that we know is true is we got this thing called AI, y'all. AI is here. It is replacing jobs and people with a prompt in a nice, clean process. And so we just got to recognize that. And there are certain things that you can do that can help you be on the right side of it. The middle is going to get hollowed out. I'm just going to call a spade a spade. So some of those routine tasks are going to be significantly automated over the next decade. It is what it is. The two categories remain very high and valued: high level creative and strategic thinking. And so the stuff that requires genuine human judgment and hands-on trades and services that literally cannot be done by a machine, electricians, plumbers, healthcare workers, these are K-proof careers, right? So we talk about recession-proof stuff. This is K-proof careers. And financial literacy is a K-proof skill. So understanding how money works, how taxes work, how to read a balance sheet, these skills let you take advantage of the systems that already exist to build wealth. Step number 4. All right, let's make sure you manage your tax footprint like the upper bracket does. Now, we ain't saying, hey, let me use your accountant. No, the income's a little different. But there are some strategies that you can put in place, right? And so one of the things that they always understand is that the wealthy doesn't just earn more, they keep more. Y'all know my motto or thing I always say. I always know when I'm talking to someone that got money. They don't really talk about making money. They talk about avoiding taxes. So having a good understanding of just capital gains and how that works, what are the tax rates? They're typically lower than ordinary income tax rates, right? So capital gains ultimately reflect whenever you own an asset and the asset appreciates and you may sell that asset, there's going to be a capital gain tax. But they are typically lower than income rate tax, right? And so there are municipal bonds that generate tax-free income. Of course, Roth IRAs, they grow completely tax-free. Another benefit is, and again, depending upon where you work, a health savings account, an HSA. So it's actually, I want to say it's actually the only triple tax advantage account based off the tax code, because that, there are a few ways in which it can be benefited. We'll use it for another time. And then, of course, business ownership creates deductions that reduce your taxable income. So make sure you work with a financial planner or a good accountant who understands tax strategy. That's not a luxury. It's really a competitive necessity. And definitely keep that in mind. And then diversify to protect what you build, right? Like you got to have some type of defensive plan that helps you during that journey. So once you start building assets, you got to protect them. You got to diversify them across asset classes. And then don't put everything in one stock. Don't put everything in one sector, right? Or even one country. International diversification matters. Especially when domestic policy is creating some uncertainty. Now, again, this is why making sure you have a vetted financial planner to support you on that. But that true bottom component of the overall role you're going to play is making sure you got an emergency fund so that when an economic shock does happen, because it's going to happen, it doesn't force you to sell your assets at the wrong time. So having a financial plan isn't just for the people who are already wealthy. It's actually most important for people who are in the process of building wealth, because those are the people who can least afford a financial mistake. All right. So let me bring this thing home. So this K-shaped economy is real. It has some history to it, which we were able to go through, and it's happening right now. Right. So the gap between the two arms of that K is getting wider, driven by asset price inflation, interest rate policy, and then just some of this disruption through the technology and the trade dynamics. And this is what I want you to know. This is not a death sentence, but the K-shape does create real challenges, but also it can create a roadmap. That's why I say wealthy people leave footprints. Because once you understand the mechanism, how it works, you can work with it instead of against it. You can start building assets. You can start thinking about being efficient with your taxes. You can start protecting your income with skills that are genuinely durable. The people on the upper arm of the K, they didn't get there by accident. Now, some did. Some they were like, oh, wow. Thanks, Mom. Thanks, granddad. But they don't stay there by accident either. You got to have strategies. So you got to have a plan. And that's exactly what we're here to help you with. So if you found this valuable, make sure you share it with your friend. Make sure you subscribe, especially someone who needs to understand this conversation. So drop a comment in the chat. Drop a question that you may have, because really this information is just the beginning. And so very, 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 very grateful to see you all again. We will continue to bring more information that is valuable for you in the community. Let us know what comments and within the comments what you want us to talk about. Also, make sure you check out our previous interviews. We've been having some incredible interviews. Host interviews actually, locally here in Birmingham, but also we pull up, wherever our people are. And so y'all know what time it is. Y'all stay tuned. And of course, stay planning.